This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice.
Welcome to the Luxembourg Fundcast.
Welcome to the deep dive. Today, we're getting stuck into a really transformed area of European finance, the whole landscape for non-performing loans, or NPLs.
That's right. We'll be digging into the EU's new harmonized regulatory framework, specifically Directive EU 2021-27, the NPL Directive, and really looking at how Luxembourg has put it into practice.
Yeah, thanks.
This analysis is designed to give you, whether you're in legal, finance, compliance, those key insights needed for this, well, pretty critical market.
Absolutely. Our mission here is to give you that shortcut, being properly informed. We'll flag up some surprising facts, maybe some actionable recommendations too. We're going to cover the 5 W's, the H, the why, what, who, where, and how of this whole market shift.
And we'll also look at how Luxembourg is strategically positioning itself, as a top hub for structuring these NPL investments. And clarify that sometimes tricky interplay between its new NPL law and the EU securitization regulation.
Okay, let's unpack this then.
Yeah.
Why did Europe even need a new framework for NPLs? What was the core problem?
Well, the genesis, it really traces back to the 2008 global financial crisis and then the sovereign debt crisis that followed. High NPL levels were seen as a major drag, on economic health across the EU.
A drag, how?
They tied up bank capital, basically, made it hard for banks to lend new money, and that especially hit small and medium-sized enterprises, SMEs, stifled their financing.
Right. So banks were kind of stuck holding this bad debt, couldn't really function properly. How did the EU go about tackling that?
So, in July 2017, the Council of the European Union adopted its action plan to tackle non-performing loans in Europe. And the key part of that strategy was developing efficient secondary markets for these distressed assets.
Secondary markets, meaning?
Meaning places where banks could actually sell these NPLs. The logic was, look, if banks can offload these loans efficiently, they clean up their balance sheets, get back to their main job, lending.
Okay, and here's where it gets interesting for the bigger picture, right? This isn't just banking regulation, is it? It ties into something larger.
Precisely. It's deeply intertwined with the goals of the Capital Markets Union, the CMU. Think of it like this. An efficient, liquid, pan-European secondary market for NPLs. That helps share risk across borders.
Making the whole system more resilient.
Exactly. The EU saw the problem wasn't just high NPLs, but the lack of a good cross-border marketplace to deal with them because, transaction costs were high and there was a real lack of transparency, information asymmetry, they call it.
Gotcha. So what's the cornerstone piece of legislation that came out of all this effort?
The main one is Directive EU 2021-2167. It focuses on credit servicers and credit purchasers, often just called the NPL Directive. Member states had to get it into their national laws by December 29th, 2023, and the new rules kicked in the next day.
And what does this directive actually cover? Who does it apply to?
Its scope is quite specific. It applies to the sale and servicing of NPLs originally issued by a credit institution, a bank established in the EU. And it gives us harmonized definitions for the key players.
Okay, like who?
Well, a non-performing loan, that's basically a loan where the borrower's missed payments or is unlikely to pay it all back. A credit purchaser is a non-bank entity buying these NPLs. And a credit servicer. That's an authorized entity that manages and tries to recover the NPLs for the purchaser.
What kind of activities do servicers do?
Things like collecting payments, maybe renegotiating the loan terms, managing the loan overall.
So clear roles.
Yeah.
What obligations does the directive put on these different parties?
Right. So for the selling banks, they have to give potential buyers all the necessary info about the NPLs and any collateral. That's for due diligence.
Okay.
For credit purchasers, they have to appoint an authorized servicer, especially if the NPLs are consumer loans. And this is crucial. If the purchaser is outside the EU, they need an EU representative responsible for compliance.
And the servicers themselves.
Credit servicers need authorization from their home member state. That authorization then gives them a passport to offer their services across the whole EU.
Right, the passporting. So this sounds like a big push for harmonization across the EU. What does that really mean for doing deals across borders.
It's often called double harmonization. It harmonizes the actors, the purchasers and servicers through EU-wide definitions and authorizations, and it harmonizes the process by mandating standard info before the sale, using those data templates we'll talk about.
My sense a but.
Yes, there's a critical insight here, and it's something easy to overlook. The directive does not harmonize the national laws governing the underlying assets themselves.
So contract law, insolvency rules.
Exactly. National contract law, insolvency frameworks, how you actually enforce debts through the courts. That stuff remains largely fragmented, different in each country.
Wow, okay. So it's like the EU built this superhighway for selling the loans, making that bit smooth and standard.
Yeah.
But once you buy them and need to actually collect.
You're back on local roads, dealing with different rules in each jurisdiction. It's a perfect analogy. Acquiring NPLs is streamlined, yes, but recovering the value, still very much dependent on the specific country's laws.
That sounds like a major hidden complexity, especially for investors looking at portfolios across different EU countries.
It absolutely is. It impacts pricing, strategy, costs. You need that local expertise.
So who are the key European supervisors making all this work on the ground?
The European Banking Authority, the EBA, plays a really central role. They issue guidelines that are kind of the bedrock of the EU's NPL framework. For instance, their guidelines on managing NPLs set expectations for banks' internal strategies.
They even set a threshold, didn't they?
Yes. They introduced a 5% gross NPL ratio. If a bank goes above that, it triggers stricter supervisory scrutiny.
So the EBA sets the standards for banks managing NPLs. What about getting information out to the market, making things more transparent?
Right. Other EBA guidelines specify the content and formats for public disclosure of NPLs and related assets. That definitely enhances market transparency.
And these new data requirements you mentioned, they sound like a fundamental shift.
Oh, they really are. The Implementing Technical Standards, or ITAS, on NPL transaction data templates, mandated by the directive developed by the EBA. They're detailed, mandatory templates banks must give potential buyers before a sale.
Why are they such a big deal?
Because they tackle that historical problem, the information asymmetry. Buyers often didn't have good, consistent data. These templates mandate granular loan-by-loan data. We're talking like 157 data fields, most mandatory in a standard format.
So this is basically the datafication of NPLs, turning them into standardized data packages.
Exactly. That's a great way to put it. It's a paradigm shift. Before, valuing NPLs was often bespoke, costly, inconsistent. Now, these templates force a granular, machine-readable standard that allows for much more sophisticated, data-driven valuation models.
What does that mean practically for buyers and sellers?
For selling banks, it means investing in data infrastructure. Significant investment, probably. But the long-term payoff is a more liquid, efficiently priced market. For buyers, due diligence becomes heavily reliant on data science, quantitative analysis. It changes the skill set needed.
A huge shift. Okay, let's bring it closer to home. How has Luxembourg, being such a major financial center, taken this new framework and woven it into its own laws?
Luxembourg acted pretty swiftly. They transposed the NPL directive through their law of July 15, 2024, on the transfer of non-performing loans. The NPL law. It came into force on July 22, 2024.
And it amended existing laws.
Yes, comprehensive stuff. It amended key pillars like the law on the financial sector, the LFS, and the law on securitization.
So what are the key new bits in this Luxembourg NPL law?
Well, it applies to credit servicers and purchasers dealing with those EU-originated NPLs. But the most significant structural change is creating a new category of specialized professional of the financial sector, a PFS, the credit servicer, or gestionnaire de credit.
A new type of PFS. Interesting. And what about the credit purchasers operating in Luxembourg? What new rules do they face?
Purchasers now have to appoint an authorized entity, like a licensed credit servicer, for servicing activities, especially for consumer NPLs. When they do appoint one, they must tell the CSSF, that's Luxembourg's financial regulator, who the servicer is.
Any other reporting?
Yes. For regulatory tracking, purchasers also need to inform the CSSF twice a year if they sell the NPLs on again, including who the new purchaser is and the balance. And importantly, purchasers are bound by a code of conduct. Act in good faith, fairly, professionally towards borrowers. No misleading info, respect privacy.
Luxembourg's known for being quite strategic in how it adopts EU rules. Did they just copy the directive, or was there a specific Luxembourg approach?
No, they definitely made a strategic choice. Instead of creating a totally separate regime, they integrated these new credit servicers into their existing well-respected PFS framework by amending the 1993 LFS.
The PFS Plus model, you called it.
Exactly. This immediately gives these servicers a sort of seal of quality and regulatory robustness. They fall under the CSSF sophisticated supervision. It enhances Luxembourg's appeal and gives legal certainty, especially for international players already familiar with the PFS system.
So leveraging their existing strengths rather than starting from scratch. Smart. What does it actually take to become one of these new credit servicer PFS? Is it tough?
It's rigorous, yes. You can't just start doing this as a regular business without CSSF authorization. You submit an application file, the CSSF checks it, makes a decision within set deadlines.
What are the key requirements?
You need to be a commercial company based in Luxembourg. There's minimum capital, 75,000 euros if you don't handle client funds, 150,000 euros if you do. Robust internal governance controls. Management needs to be fit and proper, at least 2 people effectively running it. Segregation of client funds is vital. And good record keeping for at least 10 years.
That two-tiered capital, 75,000 versus 150,000 euros, seems deliberate. What's the thinking there?
It is quite strategic. It allows for different business models. The lower 75,000 euros threshold suits more specialized advisory-focused servicers, maybe focusing on negotiation, communication, without needing the higher capital for handling payments.
Right.
Whereas the 150,000 euros requirement for those handling client funds reflects the higher operational and fiduciary risks involved. It allows the market to segment, so purchasers can choose between niche advisors or full-service operators.
Makes sense. So the CSSF is the gatekeeper and supervisor. What about that EU passporting you mentioned earlier? How does that work for Luxembourg servicers?
The CSSF oversees the whole life cycle for Luxembourg servicers, and the passport is key. For outbound passporting, a Luxembourg authorized servicer tells the CSSF they want to operate elsewhere in the EEA. The CSSF notifies the host country's regulator, and off they go.
Incoming into Luxembourg.
For inbound passporting, a servicer authorized in another EU country can operate in Luxembourg once their home supervisor tells the CSSF. It's designed to be pretty smooth.
Okay, this raises a really crucial question for Luxembourg. Securitization. How do Luxembourg's securitization vehicles, the SVs, interact with this new NPL law? They're everywhere in Lux Finance.
Absolutely critical question. Given Luxembourg's dominance in securitization, this interaction is paramount. In principle, SVs under the Luxembourg securitization law do fall within the NPL law's scope if they act as credit purchasers of these NPLs.
Meaning they generally have to appoint a licensed servicer, notify CSSF, etc.
Generally, yes. If they buy an NPL portfolio that fits the criteria.
You said there's an exemption, right? I remember reading something about that.
Yes. And this is a very important, powerful exemption. An SV that qualifies as a securitization special purpose entity, an SSPE, under the actual EU securitization regulation itself. That SV falls outside the scope of the Luxembourg NPL law.
Whoa. Okay, so what does that mean for structuring choices? That sounds like a fork in the road.
It absolutely is. This carve-out effectively makes the EU securitization regulation a kind of safe harbor from the NPL law. It gives fund sponsors and managers a major strategic choice.
Choice between what?
Either structure the vehicle holding the NPLs to fully comply with the EU securitization regulation, which has its own tough rules on risk retention, due diligence, transparency, and if you do that, you're exempt from the specific NPL law requirements like appointing a licensed servicer under that law.
Yep.
Or you structure it under the NPL law and meet those requirements directly.
And the best choice depends on?
Various factors. The assets themselves, the investors you're targeting, the transaction economics. It's a key structuring decision, a real advisory point for anyone using Luxembourg SVs for NPLs.
Fascinating. Okay, let's shift gears from the legal framework to market practice. How do you actually go about sourcing NPL portfolios now?
Well, it's a bit of a paradox right now in the European NPL market. On one hand, the overall NPL ratios at EU banks have dropped significantly to historic lows, around 1.9% by late 2024, down from a peak of 6.5% in 2014.
Which means fewer big sales directly from banks.
Exactly. Fewer large primary market deals from banks cleaning out huge legacy portfolios. But new pockets of distress are emerging. Because of inflation, higher interest rates, macroeconomic headwinds.
Where are those pockets?
We're seeing vulnerabilities concentrated in sectors like commercial real estate, CRE, loans to SMEs again, and in specific geographic regions. So investor interest is shifting.
Shifting towards what kinds of deals?
Towards things like subperforming and reperforming loans, SPLs and RPLs, loans under stress or ones that have recently started paying again, different risk profiles, and importantly, secondary sales.
Secondary sales, meaning funds selling to other funds.
Precisely. We're seeing a big rise in the initial buyers, often funds, reselling entire portfolios or parts of them to other market players, driven by wanting to lock in profits, actively manage their portfolio, or just operational efficiency.
So the market's maturing. It's not just banks offloading bad debt anymore.
Absolutely. It's moving from just a deleveraging market, banks under pressure to sell, to more of an efficiency market. Now, the initial investors are sellers too. It creates a more complex, multi-layered market. Buyers can source assets from banks and other funds, and those secondary portfolios might have already had some work done on them, changing their risk profile.
You mentioned those EBA data templates earlier, the standardized information. How has due diligence changed because of them?
Well, historically, that lack of consistent information, that asymmetry, was a huge hurdle. The EU's main tool to fix that is those mandatory ICHITES data templates. They force selling banks to provide that really granular loan-level data in a standard format before the sale is final.
How is all that data actually managed during a deal? It sounds like a mountain of information.
It is. It's managed through virtual data rooms, or VDRs. These online platforms are essential for centralizing all the documents and, crucially, handling the question and answer, the Q&A process.
Q&A.
Oh, yeah. A typical NPL due diligence can generate thousands of questions from potential buyers digging into the data. Information is usually released in phases. Maybe an anonymous teaser first, then full VDR access for shortlisted bidders who've signed a non-disclosure agreement, an NDA.
Right. Okay, let's talk price. How do you even value these things, given the uncertainty?
Yeah, NPL valuation is all about projecting future cash flows that are inherently very uncertain and then figuring out their present value. The purchase price is almost always at a big discount to the loan's outstanding balance, the OB, to compensate the buyer for the risk that they won't recover much.
What's the main method used?
The fundamental methodology is a discounted cash flow, or DCF, analysis. You estimate the amount and timing of all future cash recoveries, then discount them back to today using a high discount rate that reflects the risk involved.
What are the key metrics people look at?
Key metrics are the internal rate of return, or IRR, that measures profitability over time, and the weighted average life, or WAL, of the portfolio, which tells you how long it might take to get the cash back. Timing is critical because of the time value of money.
And do you value different types of NPLs differently, say secured versus unsecured?
Definitely. For analysis, portfolios are usually segmented. Unsecured loans. Their value is often based on statistical models predicting how likely borrowers are to repay. These models use data to group borrowers and forecast recovery rates. Rule of thumb, often valued at just maybe 1% to 10% of their outstanding balance.
Wow, that low. And secured loans.
Secured loans are more complex. Valuation is driven by analyzing the underlying collateral, the property, or whatever secures the loan critically. The final price is heavily influenced by the loan type, collateral quality, legal status, and crucially, how robust and efficient the legal and court system is in the borrower's country. That impacts how quickly and effectively you can recover value.
This all sounds like a pretty significant undertaking. What about timelines and costs for a typical deal?
It is significant. A typical NPL portfolio transaction is structured, multi-phased, takes several months usually. Just marketing a standard large pool might take around 3 weeks. Smaller or more complex ones, maybe 5 weeks or more, to let more investors take a look.
And the costs involved?
They're substantial for both sides. Sellers have advisory fees, data cleanup costs, VDR fees, plus potential accounting losses. Buyers face heavy due diligence expenses, advisory fees, maybe a non-refundable deposit, funding costs, and then the ongoing servicing fees after the deal closes.
So for portfolios with lots of small loans, those costs could outweigh the potential value.
Exactly. For small-ticket NPLs, transaction costs per loan can be prohibitively high. That's a key reason why securitization is often attractive. It helps achieve economies of scale.
Makes sense. Can you just quickly walk us through the typical phases again?
Sure. It generally starts with preparation and structuring. The seller reviews assets, cleans data, gets initial valuations, decides the deal structure, then pre-marketing non-binding offer, MBO teasers go out, buyers identified, initial bids come in. Then the intense part, due diligence, binding offer, BO VDRs open, deep dives happen, Q&A flies back and forth, final bids submitted. After that, negotiation and signing, hammering out the sale and purchase agreement, choosing the winner, signing, and finally, closing and post-closing legal transfer, file handover, data migration, getting it onto the buyer's servicing platform.
Okay, let's zoom in on that negotiation and signing phase, the legal documents. What are the really critical clauses in an NPL purchase agreement, the SPA?
Right. The sale and purchase agreement, or SPA, sometimes called a loan purchase agreement, LPA, that's the core document. And negotiation is shaped by that information asymmetry we talked about. The seller knows more, the buyer carries the future risk.
So what gets argued over most?
Key sections are definitely the representations and warranties, or R&Ws, promises about facts. The seller's R&Ws are usually very limited, often just confirming they legally own the loans and can sell them.
They won't guarantee the data is perfect or the loans are collectible.
Almost never. Sellers strongly resist that. Portfolios are nearly always sold, as is, where is. Buyers' R&Ws are more about their own legal status and ability to pay. A big fight is often over using qualifiers like to the seller's knowledge or materially.
Okay, what else besides R&Ws?
Then you have covenants, promises to do or not do things. Before closing, the seller usually promises to manage the portfolio normally. After closing, the buyer promises to comply with all laws, especially consumer protection, data privacy. Indemnification and remedies are huge.
What's the typical remedy if the seller breaches their limited R&Ws?
Usually it's a repurchase obligation. The seller has to buy back the specific loans that didn't comply with the warranty. Negotiation focuses on how that repurchase price is calculated, what losses are covered, and how long the buyer has to make a claim, the survival period.
And the actual transfer?
Yes, transfer mechanics detail the operational steps for moving the legal title, the physical files, the electronic data, and how that transfer becomes effective against the actual borrower, which depends on the law governing the loan itself.
Given these complexities and opposing interests, what are some key tactics for negotiating these deals effectively?
Success really requires understanding what motivates the other side. Sellers, often banks, want that clean break, minimal liability, a true sale. Buyers, usually investment funds, are profit-driven. They want to mitigate the risks from not having perfect information, so they push for better remedies.
Any specific tactics to watch out for or use?
Well, parties should be aware of hard bargaining tactics. The best defense is always thorough preparation. Know your walkaway point, your best alternative to a negotiated agreement, or BATNA. And the VDR and Q&A process. They're powerful negotiation tools themselves. Detailed, smart questions from a buyer's signal expertise, uncover risks, and create leverage. Conversely, a seller giving prompt, transparent answers builds trust, lowers the perceived risk for the buyer, and can support a higher price.
Right, transparency helps. Okay, one last key document, the credit servicing agreement. Under this new NPL regime, what needs to be in it?
It's mandatory now, a formal written agreement when a purchaser appoints a servicer. The Luxembourg NPL law actually specifies minimum content,
Such
a detailed description of the servicing activities, the servicer's fee or how it's calculated, the scope of the servicer's authority to act for the purchaser, and a clear promise from both sides to comply with all applicable laws, especially regarding borrowers and consumers.
And beyond the legal minimums, what are best practices?
Best practice points towards a really robust operational contract. Clear service-level agreements, SLAs, with measurable key performance indicators, KPIs. The fee structure is critical. You want to align incentives. Often a base fee plus a success fee tied to collections works well. And the agreement needs to clearly define the agreed workout strategies and how much discretion the servicer has, like approving loan modifications up to a certain amount.
Okay, so stepping back after this comprehensive look, what does all this mean for Luxembourg? How competitive is it now in this NPL investment world?
Luxembourg is, I'd say, exceptionally well positioned. Really a central hub for European NPL strategies. Its advantage rests on several pillars.
Go on.
First, its stable and flexible legal framework. You get political and fiscal stability combined with really flexible, investor-friendly corporate, fund, and tax laws. Second, its securitization leadership. That 2004 securitization law allows for tax-neutral bankruptcy remote vehicles, crucially with multiple legally separate compartments.
Why are compartments so good for NPLs?
Huge advantage. A single vehicle can hold multiple ring-fenced NPL portfolios, each with its own assets, liabilities, investors. Very efficient. Third pillar, the deep expertise ecosystem. World-class legal, tax, fund admin, corporate services providers right there, experienced in complex cross-border deals.
And the regulation itself.
That's the final pillar, proactive and sophisticated regulation. Transposing the NPL directive quickly, strategically integrating servicers into the respected PFS framework. It shows Luxembourg's commitment. It provides regulatory certainty and that globally recognized quality label.
But despite all the EU harmonization efforts, you mentioned that fragmentation remains. That's still a challenge for investors, right?
Absolutely. That harmonization gap is real. The underlying national laws on debt enforcement and insolvency are still fragmented, and that has big practical consequences. It impacts pricing. It dictates servicing strategies. You need local legal experts. It increases transaction costs for portfolios spanning multiple countries. But this is where a Luxembourg platform, maybe a fund or an SV, is ideal. It can act as the central hub managing this complexity while plugging in local counsel and licensed servicers where needed.
Makes sense. Looking ahead, what future trends should people involved in the NPL market be watching?
The market keeps evolving. Key trends I see are 1. Expansion of asset classes, going beyond traditional bank NPLs, more interest in subperforming, reperforming loans, even non-bank debt like utility bills, telecom arrears, though those might fall outside the NPL directive's direct scope.
Okay, what else?
2, servicer market consolidation. The credit servicing sector is likely to see more M&A. The increased regulatory burden, capital costs, it favors larger, well-capitalized players who can operate across borders.
And finally, any new regulations on the horizon?
Yes. 3, upcoming regulations. People need to prepare for the revised Alternative Investment Fund Managers Directive, AIFMD2. That's bringing in a new, harmonized EU regime for loan-originating funds, very relevant for private credit, and also DORA, the Digital Operational Resilience Act.
DORA.
Yes, it imposes tough new requirements for IT risk management and outsourcing on pretty much all EU financial entities. As supervised PFS, Luxembourg credit servicers will be squarely in scope. The CSSF is already gearing up for it.
Okay, lots to keep an eye on. So boiling it all down, what are the most actionable recommendations for our listeners, whether they're buying NPLs, thinking of becoming a servicer, or are a bank selling these assets?
Right, let's break it down. For credit purchasers, like investment funds. First, embrace data analytics. Those EBA templates are a game changer. You need quantitative skills now for due diligence and pricing. It's not optional anymore. Second, prioritize multi-jurisdictional expertise. Don't underestimate how fragmented local enforcement laws impact recovery. Build that network of trusted local legal and servicing experts. Third, leverage Luxembourg structures. Use those sophisticated, flexible fund and SV structures, especially compartmentalized ones. Great for efficiency, tax neutrality, attracting global investors. And fourth, conduct diligence on servicers. Choosing your servicer is critical. Assess their regulatory status, track record, tech, data security, and crucially, their local expertise.
Got it. What about those wanting to become a credit servicer in Luxembourg?
For aspiring credit servicers, first, engage with the CSSF early. The PFS authorization is thorough. Talk to them well before applying to understand expectations. Second, build a robust compliance framework from day one. Strong governance, controls, resilient IT systems meeting PFS standards, and definitely get ready for DORA. Third, define your strategic niche. Decide your model clearly. Full service, handling funds, needing the higher capital, or more specialized, advisory, lower capital.
And finally, for the selling institutions, the banks.
For selling institutions, first, invest in data infrastructure. Complying with EBA data templates is mandatory for selling NPLs. It needs serious, ongoing investment in data quality and systems. Second, prepare for a more sophisticated buyer. Buyers will do deep, data-driven due diligence. Be ready for granular questions about the data tape and defend its quality. A well-prepared, transparent data room. That can mean better pricing and a smoother deal.
This has been a fascinating deep dive. It really shows that the European NPL market, while definitely maturing and getting more regulated, is still full of opportunity. But only, perhaps, for those who really understand the complexities and use the right frameworks, like those in Luxembourg.
Exactly. And what's really interesting is that interplay between EU harmonization trying to smooth things out and the national fragmentation that still exists. It creates both challenges, yes, but also unique strategic advantages for players who know how to navigate it. And Luxembourg, with its toolkit, its expertise, its proactive regulation, it really is exceptionally well placed to be that central platform.
A truly compelling and complex landscape indeed. Thank you so much for joining us today and sharing all these insights into Europe's non-performing loan framework.
My pleasure.
This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice.
Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.